Hey everybody, welcome back to the Market Interest, where we talk stocks, finance, and the markets. Interest rates are going up, which means value stocks typically go up and outperform in this time period as well. So I want to go over 3 value stocks that I think are primed for the month of April and see where they go for the next year. If you guys want to stay up to date for all the value stocks we're covering, don't forget to subscribe to the channel. Also, go long on that like button, really helps out. If you guys want to have a one-on-one consultation, don't forget to hit the link in the description down below, and we can find out if any of these stocks are appropriate for you and your portfolio. The first value stock on today's list is Genco Shipping and Trading. Genco Shipping and Trading is a leading provider in international seaborne dry bulk transportation. They transport iron ore, coal, grain, steel products, and other dry bulk cargoes along worldwide shipping routes. Genco has had a really good year, guys, up 133% over a 1-year period of time, which is incredible. Year to date, they're up over 42%, again, which is just phenomenal, especially when you compare it to the S&P 500, which is still negative at this point in time. Genco Shipping seems to be, in my perception, just an undervalued company. They have an earnings per share of over $4. Their stock price is $23, so really good. Their price to earnings is 5.5. Again, 5.5 when average for the S&P 500 is between 16 and 17. Again, this is slightly different. You should probably compare it directly with their peers, but they seem to be in line with the rest of their peers as well. Genco currently has a dividend yield of about 4.2, which who's going to complain about a dividend right now, guys? And there aren't a lot of companies out there just handing out money. And this company's been, really focused on lowering their interest expenses, lowering any type of debt that they have so that they can pay shareholders a higher dividend. I know that they do plan on paying dividends, again, in cash instead of doing any type of share buybacks, which is nice because who doesn't want to have more cash on hand? Now, the company's market cap is going to be, it's right now, it looks like it's at $975 million. I know it's been over that $1 billion threshold. It's kind of fluctuating right in that range. So you should just consider them more small cap company. There's going to be some volatility to it. Their beta is probably going to be a little bit higher than some other companies. In terms of what analysts are saying right now, guys, it looks like they're pretty much a strong buy by most analysts. Now, they do have earnings coming up. I believe it's in a week and a half. So just keep an eye on their earnings. But analysts believe that there should be an average price of about $26. That's just about an 11% return for where things stand right now. I believe that the actual average in terms of where their price should be is going to be extended a little bit higher between the conflicts between Russia and Ukraine, some supply and demand, and then them moving their ships between the energy costs. There's some room where these companies can actually make a little bit more of a margin compared to what they were making before. So I would actually expect that the average price increase a little bit compared to where it stands right now. Looking at their profitability, guys, they have a 52%, nearly 52% gross profit margin compared to the sector median at 29%. When we jump down to their bottom line, their net income margin, 33% compared to sector median at about 6.5%. So they are just they're crushing it in terms of their profitability. That's something we really like to see, is a company that's got good cash flows, good profit margins. That means their bottom line obviously is going to be really good as well. The thing we really want to note is that they are paying down their debt in massive amounts. So they've had a lot of cash flow this past 2 years. And what they've been doing is deleveraging their book. So they're paying down a lot of debt. They had a 45% paid down. That's over $200 million paid down of debt in 2021 alone, guys. So the fact that they are have really nice margins, they're paying down all their debt. What does that mean? What does that actually mean? That means there's going to be a lot of money left over, and that is going to be paid back out to shareholders in the form of a dividend. And you can see that they've actually been executing on that dividend policy throughout one of their strategic execution plans here. Goes over their growth strategies. They wanted to sell sell older ships that they had, create more cash, start to deleverage, pay down debt, especially through their cash flows and sale of other ships, and then start paying out higher dividends. So they're executing on their plan quite wonderfully. Now, Genco Shipping has a lot more to offer besides what I mentioned here, but I'm going to have a whole dedicated video just for them next week. So stay tuned, follow up on them. A lot more details and a special surprise coming up next week on that stock. The next value stock for the month of April that is on the list here is Obsidian Energy Group. Obsidian Energy is an intermediate-sized oil and gas producer with a well-balanced portfolio of high-quality assets producing around 25,000 barrels of energy per day. Now, you guys won't see returns like this often. Over a one-year period, Obsidian Energy has a return over 500%, which is like insane. We all know that the energy sector has just been wild. Even year to date, they're up 118%, which is just unbelievable. You can't even compare that to the S&P 500. It's not even fair. But yeah, 118%. Now, keep in mind, this is a smaller cap company, maybe even consider a micro cap, or just over a micro cap. Their market cap is $725 million. So again, smaller cap company. There's going to be more volatility to this. You've got to be able to stomach it if you're in this sector. And you also I need to caution you that you really want to have your finger on the pulse when it comes to the energy sector if you're going to be investing there, because it's volatile. It's a volatile sector to begin with. And then to add on top of that, it's a smaller company. But yeah, hey, if you did invest in them over a one-year period, you're feeling pretty good right now. That's for sure. Now, it's a $9 stock. Their earnings per share is $2.25. They have a forward PE of 3.93. A forward price to earnings multiple of 4 is really low in almost any industry, guys. If we compare them with their peers, forward multiples, or just the trailing 12 multiples, they were at 2. Compared to their peers at almost 16. One wasn't even around because they didn't have any earnings. Another at 25, let's say. Another at 14. Another didn't have any earnings. Their trailing PE is really, really good. We like to have lower price to earnings multiples, right, guys? So if we look at their forward multiples, again, they're only at, let's say, about 4. And they have their peers are floating around, between 5 up to 21. At 3, Gran Tierra, I've done a couple videos on them, guys. They're another good company, really volatile, but really good company. You'll see that the price to earnings multiples fluctuate a lot between what they were trailing and what they are moving forward. I like that Obsidian Energy Group's multiple stays right around that same range, right? If we know that their earnings are even increasing, I'm even happy to see their price to earnings multiple decrease. That's showing that they're making even more money. Really, really good valuation when we look at that. Short interest is probably non-existent, which is really nice to see too. One of the things I like about this company is that they are a smaller, again, a smaller company. They can manage their operations a little bit better. They've got 3 primary locations in Canada, so in Alberta and Calgary. But I like when there's a smaller company because then they're able to be a little bit more dynamic at times. If bad things are starting to happen or things are on the horizon, a lot of times they're able to move a bit faster than some of these larger, much larger organizations. Those larger ones are kind of stuck in the mud at times. So I like the smaller companies within a volatile industry. Now, if we look at what the analysts are saying about Obsidian Energy, pretty much they've got a rating for the most part. Half of it is saying that there's a buy. Got one more saying that they should hold and another saying that they should sell. And if we just take a look at the history of what analysts have said, for the past year, they've always been at this hold rating. So if you listen to them, you would have missed out on a 500% return. There's going to be some differences in terms of how you're projecting a stock's performance and how you think it's going to do over the next year. Obviously, analysts have been conflicting in different areas here, but I'll say based on Seeking Alpha's quant rating, they're a strong buy. They're actually the highest buy rating in all of Seeking Alpha, all their overall recommendations. So they are ranked number 1 in the industry, 1 out of 73. They're ranked 1 in the sector, 1 out of 252, and ranked 1 overall out of almost 4,300 stocks. So that says something there, guys. I think that says something. It's not saying go out and buy it right away, but it's saying, maybe we should open up and determine why does this have such a high rating. I think there's something to the stock. Let's jump over to their profitability measures. Their gross margin is at 64% compared to sector median at 40%. Jump down to the bottom line. They've got a net income margin of over 92%, which is wild, compared to sector median at 7%. So they're crushing it, knocking it out of the park. That's a really, really strong performance there. Now they've got a D rating in terms of their levered free cash flow margin, and they've got some debt. This company has some debt, so clearly, their margin in this area isn't going to be doing so well. But hey, if they have a lot of cash flow, really large net income margins, they're able to use that cash to pay down debt as well. They're clearly not using any of that cash flow to pay a dividend because they as we see on this other page here, they're not paying a dividend. So this is not the type of company that you're going to be investing in to just receive income. It's not that type of like value, like income oriented company. This is going to be for a price appreciation. We're looking for a company that is undervalued at this point in time and has room for price appreciation growth instead of dividend income. So that's number 2 on the list for today. Let's jump over to number 3, which is Zim Integrated Shipping Services. Zim is a publicly held Israeli international cargo shipping company and one of the top 20 global carriers. The company's headquarters is in Israel and also has a North American headquarters in Virginia. Zim operates in select trades where it has a competitive advantage and where it can provide superior service. Zim is considered one of the bigger boys in this industry. They have a market cap of nearly $8 billion, so they're really a pretty large organization here. Their market price is $73, close to $74. But let's take a peek at their return. For them being a nearly $9 billion organization, they had over a 200% return this past year. That's huge. That's huge, especially for an organization this large. Let's take a look at their year-to-date returns, up 30% year-to-date. Now, make sure you sit down before you listen to this next part, guys. They have a dividend yield of 26%. 26%. That's crazy. Most companies don't have a dividend yield that high. That means these guys have done a really good job at producing a lot of revenue and paying down debt and making sure they have a lot of cash left over after the fact. So I would expect that this company actually doesn't have much debt at all. Let's dive into their dividends real quick. If we look at their dividend history, you can see that in 2021, they paid a small dividend. They did have a quarterly dividend, looked like they were establishing some type of dividend policy. And in 2022, now they have a quarterly dividend and it was paid out of $17, which is awesome. And you can also see the amount clearly changed. So in terms of their sustainability, the dividend sustainability, I'm not sure if that's always going to be there, but it looks like they have some type of policy where it was paying out, 50%. Yeah, in terms of their summary, their dividend summary, they have the forward yield of 93%. That's insane. But their payout ratio over 50%. So, and it looks like they're newer to paying dividends. It seems like a lot of companies in this industry are newer to paying dividends. So that's really a sign of something, guys. Usually a sign of stability when a company is able to receive all that cash flow and keep paying a dividend. Now, analysts all around are saying that this is a strong buy company. They're also ranked number 1 out of 24 in the industry, ranked number 1 out of 561 in their sector, and ranked number 2 out of close to 4,300 stocks overall. So again, really strong performance here, and that's not just through not just Seeking Alpha's performance, but that's a recommendation. That's also Wall Street analysts as well. Analysts are saying there should be an average price target of about $85.30. That's going to be close to a 16% return in terms of what they're estimating. Now, this company is facing the same exact challenges and opportunities that Genco shipping was. So, there's different ports within the world that are not accessible compared to what they used to be because of the Russia and Ukraine crisis. Also, energy prices are going through the roof. Let's look at their profitability measures. Their gross profit margin, 63% compared to their sector median at 29%. Jump to the bottom line, 43% net income margin compared to 6.5%. So again, you can see why they're a really profitable company. Really, really profitable. You can see why they're also paying so much out in a dividend. If they're taking in this much cash, their margins are so thick, they can afford to pay out a really good dividend to their shareholders. So again, this is another company I think is primed for another couple of years. I don't think as you guys know, I don't think energy costs are going down. And this company is very affected by the cost of energy. So I actually feel like it's a good position for these guys for the next couple of years. I'd be comfortable with hanging on to a company like this for at least a year. I really think investing into this company for a year is a solid play, at least for my own portfolio. And then reassessing as it gets closer towards that anniversary date. I think the industry as a whole has some opportunity over the next 2 years, potentially even 3. But playing this, year by year basis, I think would be a smart move, especially with a company like this that has a strong dividend. So those are my 3 top value stocks for the month of April 2022. Again, I think value stocks are the place to be this year. I really do. With interest rates going up, that generally starts to dampen down any growth opportunities or as much growth opportunities within growth stocks, and we really start to see value companies outperforming. Not saying there aren't great opportunities within some growth stocks as well. I think that's there's always opportunities somewhere, but I think right now is really just a prime spot for value companies to outperform growth within this next year. So these are the 3 on my list. If you guys have any questions in regards to the stocks here, or curious if you should be investing in these yourselves, click the link in the description below. There's a way you can reach out to me. We can have a one-on-one consultation and see if these stocks are appropriate for you. Also, if you have any recommendations in terms of other stocks we should be reviewing in the future, jump onto Facebook at The Market Interest, and we can have a discussion over there. You can make any recommendations and see these videos as well. So with that, guys, I look forward to our next video. I'll catch you guys next week. Take care.